Hey, thanks for tuning in. Today I'm going to discuss moving averages and how I use them. In this video, we're going to be looking at the stock NVIDIA going back to the year 2015. This stock will be the example of how a trend can continue for much longer than most people think. So first off, I'm going to discuss the moving averages that I use up here in the top left. TrendSpider does a good job of just summarizing every single one of them based on color, and then we'll tell you where they are based on the day that you select, which is at the bottom of the screen. So I use simple moving average 40, 200, 100, 20, and 10. And the only exponential moving average I use is the 5, EMA 5, and that's yellow. So you can look at the length of the moving average or really just as like a shorter term or longer term trend indicator. So the first thing that you'll look for is whether or not we're in trend mode or we're in a correction. The first thing that I'll look for to determine if we're trending is the slope of the moving average. If the slope is 0, well, then there's no trend, right? If the long-term moving average is, and you going back here to 2015 and 2014, there was a bit of a basing period in NVIDIA. And then as you can see, the moving averages got very tight and exploded. The distance between all of the moving averages got quite far. She then put in a correction. Elliott wave standpoint, a zigzag, and then the next impulse wave began. So when we look at this particular setup, it's important to note that back here was when the trend was at the very beginning, and that the shorter term moving averages tend to roll over and will be the first signs of the rollover. So when you see the 10 and the 5 and the 20 period moving average start to curl down like they did back here, price closes below, back tests this key level, and then the sellers just show up. When that happens, a lot of traders will exit the trade when the 8 or the 21 day moving average is lost. Because generally what will happen at the start of every correction is you'll give up the 8 and the 21 period moving average. It's a good rule. As a mean reversion trader, someone who likes to buy ABC corrections into long-term moving averages, I would have been looking to buy down here and right here. That being the case, we want to talk about the slope of the moving averages. And as the slope got quite excessive in the blue line, which is my simple moving average 40, and the distance between the 40 and the 200 became about as far as it had been, the risk is its highest. So when the moving averages were all close to each other back here, your risk is its lowest. There's no trend, right? The slope is sideways on the 100 and the 200. And even back here, the 10, 20, and 5 were all sloping down. The risk increases the further away SMA 40 gets from the 200. And you'll notice that as we progress through time. So that's kind of how I use the distance between the moving averages. In general, it's just to try to give me a measurement of how long the trend has been going on for, and generally speaking, my overall risk level, because more often than not, price reverts to a mean. And I use this home base concept or just mean average. The Bollinger Band system uses it as well, so that over time, really nothing likes to get too far stretched away from mean, and that mean in my system is SMA 20. Some people like SMA 10. But it's basically the same thing, right? Over time, price will not get too far away from the 10 or the 20. And this is the daily chart. And if we were to zoom in to the weekly, you would notice that during this period of time, price was getting pretty far away from the 10 and the 20 on the weekly. And so if you look at the final concept of like a moving average cross, you will see that the crosses on, let's say, the 5 and the 10 are valid, right? But they're not as valid as you think. Like, so the 5 crossed below the 10, but then she ripped. Well, then the 5 crossed above the 10, so it gave you another buy signal. So, I mean, they're definitely valid, but you get lots of false positives is the point. So, if you wait for something like the 10 to cross above the 20 or the 20 to cross above the 40 to buy, that would be back here on August 11th, you'd be buying up here. Well, she then fell 15%, right? So it's kind of hard to say wait for the moving average cross and then buy. Generally speaking, these are lagging indicators every single time. The moving average cross is the slowest moving average indicator. It would be better to buy when price captures SMA 20 instead of waiting for SMA 20 to cross the 40. However, what it did set up was the next time price dipped into the 40, that became a buy. And so these are bullish indicators. They do tell you that the trend is reversing from down to up. They show you in a visual way that is happening. But it also is a lagging indicator so that you can get these retraces back to the mean often. And the best type of those retraces back to the mean are when it happens on the 200. The 200, historically speaking, is the best moving average. If you do nothing as a trader but buy dips into the 200 on the daily, on the weeklies, as long as price remains above that moving average, and on major indexes like SPY and the Qs, they often do, you will generally have the best entry. And for people like investors that like to build this portfolio type approach and hold positions for long periods of time, accumulating at the 200 is generally your best bet. So my favorite setup is to combine the Elliott wave structure, the Elliott wave corrective patterns, the zigzags and the flats and the triangles to be specific, combine those structures with the moving averages to give you a confluence of support. Not wait for a moving average cross or wait for price to capture a moving average. No, all of that stuff is a lagging indicator. That's why I use Elliott wave corrective patterns to develop risk reward setups that are skewed in my favor. So from a moving average standpoint, that's pretty much how I use them. It's not that fancy. This system that I'm explaining to you right now is 100 years old. This is what moving average traders have been doing for very long periods of time. But let's take a look and just progress a little bit further through this chart to show you how long this trend can continue. So this is the first correction to the 200. She stayed here. She closed below on one day, reversed to capture, back test, try to close below, left the station. So there's tons of games that take place. Oh, I put my stop, they closed below, they stopped me out, then they left. Well, that's what they're trying to do. They're using that moving average as a guidepost, not as an absolute arbiter of whether or not the trend is up. It's not like because she closed below on the 200 today, February 8th, 2016, that the very next day when she recaptured it, that meant the trend was back up and then it was down again when she went below. That's not how that works, right? This is a corrective pattern that started up here that was going to end somewhere down here at the 200. It's a guidepost. It's a destination. Same thing happened here, but on a shorter term time frame. another ABC correction into the 40. And you can see that really a strong stock in a strong market will only pull back to the 40. Right? Your 5 and your 10 and your 20, they provide aggressive entries for aggressive traders. But for the conservative traders, you want the blue line, the 40, you want the 200, right? These are your go-to entries. And as you can see, she just kept going. So from 20 to 120 bucks. Another little ABC flat right here. As you can see, this time the distance between the 40 and the 200 was getting too far, and as a result, time was required for this correction. So December 2018 to May, almost 6 months, 5 months. And as a result, all the shorter term moving averages got caught up with price. You never touched the 200, but the distance between the 40 and the 200 was as low as it had been in probably a year. You'll notice that during this long correction in time, the shorter term moving averages, the 10, the 20, the 40, cross back and forth over and over. This creates all these false positives. Oh, I bought, then I sold. Well, we had the 40, we bounced, and then we gave it up. Well, that's because that's an ABC zigzag lower, right? That was the correction, right? A, B, C. And that's your pattern. Right here, the 40 was too far from the 200. Sellers overwhelmed buyers at this price level. The volume shows that. The corrective pattern began. Your typical ABC. Down, up, down, into the moving averages. The moving averages then got very close. Another gap and go in NVIDIA. This got all the shorts trapped again. All the shorts that piled in over that 5-month period were now trapped. Forced to cover. Boom, brand new moving average trend look. Right? The 5, the 10, the 20, the 40, and the 100 all exploding up again. So this is a perfect example of how all the bears were hoping for this to roll over, for the 40 to cross below the 200, and for the trend to start taking a breather. Remember, she had just gone from $20 to $120 in a couple years. Nope, she keeps going. Gap and go. New life into the trend. And this is really where the phrase, the trend is your friend till the very end, comes from. I mean, this type of stuff continues for way longer than people think. $200. Another pullback into the 100 this time. Sellers exhausted. Boom, continue higher. 250s. Still pullbacks into 100 get bought. The moving averages coil back. They're getting closer and closer in time. They've gone sideways now, almost a year. And this is where they try to keep going higher, but get stuffed. And this here is 2018, start of the trade war. So when you had the trade war come in, this was the excuse that was used to liquidate positions. 295 all the way to 120. All the moving averages roll over at this point, right? This is a rollover look. You give up the 200, but this time you don't go higher, you go lower. They base at the 200. The bulls fail to defend. They capitulate. They have not sold in years. $20 to $300, an epic run, and you capitulate. They give up the 200. Boom, ABC. One zigzag up. Boom, another impulsive move lower. Another move up. Didn't break this high, telling you that it's all still part of this same impulsive wave lower. Another boom, break the low. That's a 5-wave move lower. At that point, you could tell that the move had completed when she had broken this level. all the moving averages are much, much extended to the downside. The 40 is really far from the 200. And this gave the bulls a chance to try to defend the 40 and rally from here. But to repair this job, right, we need to get the 40 back above the 200. We got to get the 100 back above the 200. And as you can see, as price came into the 200, she failed. Couldn't even tag it and ran all the way back down to 130 bucks. But she held the lows. And this is what gives the bulls a chance to build a new impulse wave. And from here, they tried at the 200 again. And they failed again. Second attempt at the 200 failed. But at this point, look at where all the moving averages are. They're right back where they need to be to give you that brand new trend look. At this point, there's no trend. The slope of all the moving averages is zero. They're going sideways. So here, at this point in time, August 21, 2019, the trade war magically stopped. And as a result, she was allowed to now capture the 200 again, get above the 40. And those who thought they missed it because they didn't buy down here at 130 and they didn't want to buy up here at 165, never bought. And then she went from 165 to 315. Put another ABC zigzag to the 200, just like back in 2015. And boom, off to the races again. So that concludes the video. I hope you get a good understanding of how I use the moving averages, how they are lagging indicators, how during a trend period they will, continue up. The slope will be up on all of them, and the distance between them will get very large. And during a consolidation period, the distance between them will narrow, and the shorter term moving averages will cross below. How crosses are lagging indicators, the concept of home base, and how price always reverts back to home base or mean. And how I use Elliott wave structures with the moving averages to give you a high probability buy or sell setup. So really that concludes the video. If you like the content, please like or subscribe to the channel and like this video, and we'll see you around.